Hey guys, welcome to the Startup Tank Climate Investor Pitch Show, the show where we get the world's top climate companies, the folks that are tackling real big, dirty, real world problems on, and we try to get some funding. Today, I'm hosted or joined by Pratibha Vuppuluri. I'm sorry, Pratibha. I'll do my best. I always get somebody's name wrong. From Unreasonable Ventures or Unreasonable Group. She'll give a little bit more of a breakdown of herself and what they do there. And unfortunately, our other two investors, well, as is anything with tech, sometimes things break, sometimes things fall apart. We lost them, so you're going to have to deal with us as your sharks, so to speak. So I'm your host, Matt Ward. I run 4WARD.VC. We're an early stage climate syndicate and climate accelerator. Big news. We're actually officially announcing that on Thursday, but our partner in crime program partners with really promising early stage climate companies on a networked growth hacking approach to try to help them get new clients, new customers, and scale before raising that all important seed or pre-seed round. If you want to learn more about us and what we do, you can find us at 4WARD.VC, the number 4WARD.VC. If you like the shirt, my sister made it. Happy to give you recommendations if you need someone to get a shirt design done. And if you need recommendations on where to find funding, then you should definitely check out our climate VC database. That's just at 4WARD.VC/VC database. We've got 850 or so funds on there, incubators, accelerators, CVCs. It's all indexable and searchable by stage, sector, geography, and check size. So if you're looking for your ideal investor, and you're based in Chile and making a food tech company and trying to find investors that have exposure or focus on Series A, you can find exactly them. Again, that's 4WARD.VC/VC database. And all of this is brought to you guys by Valbon, by Carta. If you didn't notice, Carta bought essentially the biggest player in the business of SPVs, and that's who we love and use with our syndicate at 4WARD.VC. So as I said, we've got our accelerator, we've got our syndicate, and our syndicate invests in early stage companies that are really making big dents on the world. Kind of like some of the companies here. We love Carta and we love Albon because it makes it super fast and easy to set up an SPV, but it's great for founders too if you want to handle kind of ESOPs, cap table management, equity and shares for your employees, and all the ins and outs of running a venture business. To learn more about them and what they do, visit 4WARD.VC/Carta, CARTA. Use that link to know and to show some love for the Startup Tank. The Startup Tank, of course, is your Dragon's Den or your Shark Tank for climate companies. And we're also brought to you guys by the Yugen agency. We've got a pretty cool bonus for anyone who's tuning in and actually pitching tonight. So the winner our Startup Tank Climate Startup of the Night, that Pratibha and I will crown at the end. Normally we have a few more investors, but some of the sharks got hunted out of the water, so to speak. So whoever wins that award, they'll get 5,000 British pounds and free services. That could be a pitch deck, that could be branding help, that could be a website template, etc. From the Yugen agency. We'll have links, etc. in all of the descriptions. You can find out more at 4WARD.VC/design. But now I've done enough talking. I want to bring in Pratibha with Unreasonable Group and then tell you guys a little bit more about the format. Before I do, Pratibha, do you want to hop in here and share a little bit more about yourself and what you guys do over at Unreasonable?
Absolutely. Firstly, thank you so much, Matt, for having me on the show. My name is Pratibha Vuppuluri. I know it's a bit of a tongue twister. I head up the investments here at Unreasonable. And by way of quick context, Unreasonable partners with large corporates and invites high growth, high impact ventures into what we consider to be ecosystems of support, where we envelop them with mentorship, thought partners, strategic opportunities, as well as financing. I also started a syndicate platform here at the Unreasonable Group called Unreasonable Collective, where it's manager-led syndicate model. So we look at sourcing, screening, evaluating companies within the fellowship, so within companies who've joined these ecosystems of our support. And we present it to our investor base that is a core part of our community. So to date in our fellowship, we have a little over 300 companies globally, and at a collective, we've deployed roughly around 10 million in 15 companies.
Not bad. And we at 4WARD.VC, we invest in companies that move the world forward, and we accelerate them with what we like to think is the biggest, most hands-on and strategic networking focused growth acceleration program out there. For more details on our partner in crime program, because we will be your partners in crime, it's just 4WARD.VC/accelerator. But this is the startup tank. You're here to pitch your companies. You're here to raise money because, let's face it, A, the economy sucks. B, you're building climate companies, which take a ton of cash to grow and scale. And you could probably use the help for growing, scaling, building out the team. Format of the startup tank for anyone who's new. Each company will have 5 minutes to pitch. We're hard on the timer. And then about 10 minutes or so of investor Q&A. At the end of the night, Pratibha and I will crown a climate startup of the night. And that company will receive 5,000 in free credits for design work from the Yugen agency. That could be anything from pitch deck, product design, MVPs, prototyping, etc. And consolation prize, any of you guys who are listening, or sorry, any of you guys who are pitching, you get a one-on-one discovery session with them on branding and positioning for raising your round. Either way, should be hopefully very helpful. And now let's kick things into the actual program itself, because you guys are here for the companies. You're not here for me, let's be honest. And without further ado, then I think I would hand things over to Leo. Are you ready with Factoree?
Yep.
And just let me know when you're ready. I'll give you a 1-minute warning and things should run nice and smooth. Sound good?
Yes, I'm good.
Let's do it. What's sustainable manufacturing look like?
Okay, so thanks a lot for the opportunity to share with you what we're doing. Very fast forward, there are tens, if not hundreds of thousands of factories who has huge challenge of both go on and producing and in parallel reduce carbon footprint and huge amounts, which basically means that COOs in this world need, first of all, a tool that will help them to understand what is actually going on the ground in terms of footprints, and will help them to budget and manage the reduction processes for the next 15 years. And this is exactly where Factoree comes in. Basically, what we are doing is to aggregate data from different sources in the production floors, automation layers, ERPs, quality systems, aggregate all this data automatically and produce automatic models of the production process. In this case, for example, you can see a process of a synthesis. And the idea is that we are analyzing all the data and automatically identify the main steps of the production process across products, across sites, and understand exactly what goes in, what goes out, and how much time each step takes, which allows us, first of all, identify exactly what are the different emissions which are associated to different production processes, set operational environmental goals, and following that, detect opportunities of reduction, whether it will be different areas of detection of operational anomalies, changes of energy mixtures, or different elements regarding raw materials. Factoree has been established a year ago. Since then, immediately we've got a lot of data from our design partners, which is a Syngenta group, and immediately made in the last few months, we actually went through a big number of POCs, and currently we're starting our initial go-to-market with the Syngenta group around the monitoring part. And during 2023, we are planning to launch the diagnostic package as well. We're currently raising our seed round, following to a save that we've already raised. I'll be very happy to answer any question. Thank you.
Wow, very fast, very efficient. Thanks for that. Let me pull Pratibha back in here, and then we can get started. While I'm doing that, I mean, my first big question is just, who is your ideal customer then? Is it chemical companies and producers? Who are you looking to sell to?
So we are the type of companies we are starting with are chemical companies and building material companies, and all the material manufacturing world. And within the organization, we are targeting COOs, and in the future, we'll also target CFOs, but we're not ready for that yet.
You want to take things away, Pratibha?
Sure, absolutely. Could you speak to your tech stack a little bit more? I'm curious about, is this something that you are looking at, just the data points that you've trained your, or data set, what is the outcome that a COO would be receiving? Is it recommendations? It's just love to understand a little bit more on that.
Yeah, so very, very fast forward. This is the Factoree. This is how it looks. Usually it contains a lot of different production lines sitting in the specific buildings and a lot of utilities that supporting these production buildings. Within this stock, you have different systems, ERP, quality, many data points. That first of all, the goal is to aggregate automatically and extract out of all this mess one big understanding of how a production process looks like, something like that. We are limiting ourselves, by the way. The approach is to provide a horizontal view, which basically means to understand what are the steps, what goes in, what goes out, and how much time does it take. In the minute that you have this thing automatically and you can actually trust it, so first of all, you can set operational KPIs and environmental KPIs, allow the COOs to set operational and environmental KPIs to each site in which you will find Factoree, and start the reduction process, move forward. And the other piece, sorry, I don't have it here. And then the other piece actually to look on different abatement opportunities, whether it will be detection of operational anomalies, whether it be different elements of energy mixture, changing of raw material, and over time we'll of course will implement other things like carbon capture and stuff like that. But the idea is that if you're a COO and you have 100 or 50 sites around the world, they all the time has been analyzed, you understand exactly what is going on, and the system is looking for opportunities for reduction. As in each place, in each geography, in each production process, the opportunities will look a bit differently. So the idea is to flesh where the opportunities are, combine them with the strategic aspirations of the organization, and provide a system that identifies these opportunities and pushing it forward for execution.
Got it. Thank you. Can I ask one more question, Matt, before?
Yeah, of course.
Curious about your pricing model. How does that look?
So we are focusing on a site level pricing because for us, it is a fundamental element to cover the site end to end. And as a starting point, we have, for chemicals, for example, we have small site, mid-size, and big sites. The price point for big size sites would be around 150K. But of course, this is the prices that we're starting with for the monitoring piece. And there is still way to go to validate this approach. For sure, it has to be on the site level because analytically wise, we have to cover the site as a whole. Otherwise, we will lose huge amount of data and won't be able to fulfill our tasks.
Got it. Thank you.
Which of the MD or R do customers find most valuable and why?
Sorry, I'm not so sure.
Monitor, detect, and reduce. Which of those three is kind of the big value? Which is the one they have to have, and which are the nice to haves?
Well, eventually they have to have all of them if they want to reach their operational goals. Usually it's a bit hard to detect if you are not monitoring. So, it's an evolution. It's easier to provide the monitoring. The detection and the reduction involve recommendations, so it takes more time to develop. But eventually they need all of them.
What's your background? Why are you doing this?
So I'm dealing with process optimization in manufacturing for the last 8 years. My previous company was still dealing with deep optimization of processes. I'm dealing with digitalization in general for the last 25 years and dealing with environmental areas for the last 15 years. both as a not-for-profit, as an investor in different companies. So it's areas that important to me. That's not much. And by mistake, I also understand data infrastructures in manufacturing.
Is that what makes you unique? There's a lot of people trying to create digital twins of either supply chains or manufacturing processes, etc. Why are you guys 10x better?
So first of all, I don't know if we're better or worse. I think that looking from the startup perspective, I think there are two elements. First of all, we know that infrastructure and manufacturing, it's not something it's not something straightforward. I mean, there are many people who can learn to do it. The entry barriers are relatively high. It takes time. The other element that we have very deep design partnership with a lot of factories, and we've basically got full data infrastructures of these factories before starting write code. Usually, if you will try to do it yourself, it will take you at least a year, if not more, just to get to a point that you are starting to look on data. So I assume that we are well positioned to run faster than anyone else. I don't think that we have something more unique than that.
But if you're running,
sorry, go
just
ahead.
one follow-up to that, and then you're up, Pratibha. Sorry. Yeah. If you're running faster than everyone else, but there is so much setup and time, how do you scale something like that quickly if it is really intensive and hands-on in the modeling process?
So, and I think this is exactly the thing. Today, it takes us around 3 days to create one model for one product, which, by the way, good enough to start with. And within 6 months from now, we will do a situation that we're doing it within 3 to 4 hours, including the QA of someone on the ground. And this is basically the key, the capability to do it fast, which means also that you can do it much cheaper. You know, to compare companies that are dealing with process optimization, for example, who didn't invest in the scalability of the onboarding and AI systems to support it, can do it today within 2 to 3 weeks of onboarding for one production line, which means basically that their business model, under their circumstances, they have to charge at least 100K a year for one production line. This is basically what we're targeting for the site as a whole.
Okay. Pratibha?
So that's super helpful, Leo. Curious about your projection for this year. Could you speak a bit to the pipeline and how confident do you feel about being able to meet the 2023 revenue target?
So I'm pretty much confident. We already submitted the first purchasing order to Adama with the first 3 to 4 sites. And right now it's under approvals. And the next step would be Standard Industries, with whom we're already starting to work, and Syngenta Group. In terms of pipeline, I think we are good. We have very deep relationship in this sphere, and very good relationship with strong channel partners as well. As an example, my chairman for the last few months is actually his name is Alec Fox. He was a number 2 in Rockwell Automation in the global one, the SVP corporate development of Rockwell. So we're already starting to work with Rockwell towards the step when we will be mature enough in terms of digesting more projects. And we have our own internal relationship with manufacturers that I've built for the last 8 years. So I guess first step, we are good. Next step, anyway, will come through channels. We won't do it ourselves.
And as Matt alluded, there are several players in the market trying to attempt to do this. I'm curious to hear, who do you believe is your closest comparable today?
It's a great question, because basically there are 2 main segments who are approaching more or less the same challenge, but from completely different angle. One would be all the environmental accounting companies. I don't think that it's a real competition. We certainly not look at it as a competition, because environmental accounting companies don't have the data and the modeling that we have. as simple as that. And we are not building environmental accounting modules. So actually in the future, we will push data to this type of solutions. From the other side of the spectrum, there are companies who are doing things like we used to do in my previous company, which is different process optimization companies. They certainly have the knowledge to do this type of things exactly as we do, but they don't have the technology, because to optimize one project process versus analyze horizontally all the factory, it's completely different products and completely different technological stacks. So theoretically, there are companies who can do it, and I believe that there will be companies that are doing it. On the big companies level, those who I'm communicating with, like Rockwell, like Schneider Electric, like Honeywell, they're not doing this type of things yet, because they're trying to reposition their own products. From the startup perspective, again, to move from process optimization to what we are doing, it's like to build a new company with people who know what they are doing, but still it's a completely different technological stack. And this is why I'm building Factoree as a new company and not doing it as extension to my previous one.
Got it. And in terms of the financing left that you will need to undertake to create to get this product to profitability, how do you anticipate your cap structure looking like over the next 2 to 3 years?
So to get to a point that we can support the massive penetration, which would be, let's say, 60, 80, 100 sites, we're right now estimating on the engineering level that we will need around $4 million to get to this point. And this is basically what we are planning to do within the next 18 months. The main technological barrier is actually to jump from a few sites to 60 to 80. If you have 60, 80, you have 800 as well. You're actually getting closer to the full stack SaaS value proposition. Okay. In between, you're not building everything today. Part of the things you are trying to postpone because we don't have enough resources yet. But right now, with 4 million, we will get to an infrastructure that will allow us to implement effectively the monitoring piece and come out with the initial value propositions around the diagnostics. I'm emphasizing initial because the diagnostic part is, it's never-ending story, and there is a lot to add, a lot of depth and IP to develop around this world. As I said, right now we're looking on detection of operational anomalies and energy mix and all these type of things, which are closer, let's call it, to positive ROI, which is good supporter to fast implementation because it creates value. Later on, we will have to touch things which are not more complex technologically wise, but business wise, it's certainly more complex, like carbon capture and changing of raw materials and stuff like that.
Thank you. Matt, over to you.
I think that's everything, so that we have enough time for all the companies. But Leo, thanks for sharing. It's very interesting what you guys are doing. It's clearly something that needs to be there. Again, it's just the kind of race to be the one who does this the best. And if that is venture scalable and how scalable it is my big questions. But thanks for presenting it either way. And I want to move things on now to our next company of the night. How about Justin with phelas? Do you want to take over, Justin, and share a little bit more about what you guys are doing for a renewable energy future?
Sure. Thank you very much. I hope you see my screen.
Looking good.
Okay, let's go. My name is Justin. I'm the co-founder and CEO of phelas. And as we like to say, we make the sun shine at night. Now, we want to make 100% renewable energy globally a no-brainer. And before I start now with the pitch, I wanted to remember 3 things at the end of my pitch. Number 1 is which problem are we actually addressing? Number 2 is what does our solution look like? And number 3 is what do we make different also in our business model? So to understand the problem is not that renewable energy is expensive. It's the cheapest source of electricity in human history. That has been officially also announced by the International Energy Agency already in 2020. So you might wonder then, what is the problem? And the problem is the intermittency. By now, most people know that the sun doesn't shine all the time and the wind doesn't always blow all the time, but we need a solution for that. And the solution is actually to shift large amounts of energy from when we have more than we need to when it's not generated with energy storage. Now, our solution is an energy storage system combined with a software component, but mainly we're talking about a liquid air energy storage. It's a containerized solution. And what really makes it unique is its flexibility, its scalability, and its low cost. Now, how does it work? Sounds super complicated. Liquid air, what is that? The simplest way to think about it is the same way that if you boil water on your stove at home, there's pressure increasing. And if you have water vapor and you cool it down, it becomes liquid. We effectively do the same just with air, not with water. Now, why do we do this? There has a couple of benefits. A, it's a scalable solution because it's containerized, because it is modular, we can mass manufacture it and leverage economies of scale using mass manufacturing. It is low cost because the materials we use are mainly steel, gravel, and air, and we're probably not going to run out of gravel anytime soon. It's modular and transportable, which allows a new kind of business model, more on that in a bit. We have filed a patent on the process, yet the most components we use are off the shelf. So that is a good de-risking on the technical side, yet having defensibility because of the patent on the process. It's a very safe system, and we can build it with local supply chains, may that be Western supply chains, Asian supply chains, becoming increasingly important when we talk about the energy space. Now, who wants that? There's a couple of different customer groups across the value chain, from generation to transmission to demand. And we, as we speak, have a first pilot customer on the side of the commercial industrial. It's a wood pellet factory in Germany who also has renewable energy generation on site, but that company is wanting to build with us the first large scale system. Now, I mentioned as the third part, the business model. And the classical business model is for most energy storage, you sell it, maybe have a service contract, thanks, but that's it. But that does not incentivize sustainability. When we started the company, we wanted to make a scalable company that has sustainability in its core. And our system lasts 20 to 30 years. It has no degradation. But our customers might only care for 5 years because their project lifetime is 5 years. So there's no financial incentive for us to build a more sustainable, longer lasting product. And that is something that we wanted to fix. And the best way to fix this by going towards energy storage as a service. So that means the customer has a recurring revenue, has a recurring subscription to a storage on site or even remotely. And then after 5 to 10 years, we can relocate because it's containerized, because there's no degradation. So we can charge per use, but we don't have any cost per use. Now, who's building this? We're a top level team of 13 heads by now, 7 full-time. We cover all relevant areas of the business, mainly focusing around 3 core pillars: strategy and operation, product, and marketing customer. Because in contrast to most deep tech startups, we didn't start with the technology. We started with understanding there's a market need for long duration energy storage and then developing a technology exactly for that customer and market pull, not the other way around. Now, we are raising right now money. That's why we're here, to quote you from the beginning, Matt. We are raising a 6 million seed round. This round will allow us to scale up from a prototype in the lab that we have
40 seconds.
Today. Yes, thank you. And will get us 24 months of runway. But now, last but not least, I told you in the beginning, you should remember 3 things. I want you to remember one thing, and that is we want to make 100% renewable energy globally a no-brainer. And that is all I wanted to remember. Thank you.
Awesome. I think we can remember that. I think we can all toast to that. Let me pull myself and Pratibha back in. Pratibha, do you want to take things away? Do you have questions for Justin and Phelas?
Thank you for that, Matt. And thank you for the pitch, Justin. To perhaps kick off, do you mind sharing a little bit about yourself? And love to understand the team's unique capabilities and skill set to be able to pull this off.
Sure. So short background story about me. I co-founded my first company in parallel to studying my bachelor, did some import business. It took away the fear of founding. Like in Germany, that's very prevalent, that there's a big fear of founding a business. So that was gone after that. My personal background education-wise is industrial engineering and then material science in my master. But after that, I had the privilege to travel around the world, saw a lot of the world and how different it can be, and also what it might mean to build globally scalable solutions. And then worked in 2 startups afterwards, one medical AI startup and one a semiconductor hardware startup, before then being frustrated with management in most places and saying, okay, if I'm already always frustrated, maybe I should do it myself, so I'm at least frustrated with myself. So that was combined then with a longtime friend, Leon, co-founder, who analyzed in a techno-economic analysis, do energy storage actually, are they profitable if you put them on the Iberian grid? And that sort of jump-started the whole phelas endeavor. And then from a team perspective, we have we hired Masoud, who is came from one of the best universities of Turkey, got him to immigrate to Germany. Pitt is a top physicist. And Christopher is actually the brother of my previous co-founder. And he has a business psychology background. So it covers a lot of the operations early on, which is super valuable, but also having good contacts into the DAX, German highest companies there. And bringing that all together, what really is interesting is that it's very differing viewpoints, yet there's always a consensus that we strive for understanding in the team. So we always get the feedback that when we discuss or when we communicate, it's very different. Yeah.
Love the richness and the experiences and the team profiles. I'm curious, given that you guys started off with really looking at the pain point and the landscape, do you mind sharing a bit about the players in the market and what makes you guys unique?
So there, in the market that we're focusing on is the so-called long duration energy storage. So that's anything above 6 to 8 hours. Lithium battery storage projects are now somewhat getting into that range, but if you ask me, they're just still too expensive. It's just that the market is so bad that these expensive projects are actually able to proceed. Looking at the long duration storage, there's different technologies, different companies at different stages. What we most see being proposed are these OEM kind of solutions. I build a large facility, I build monoliths, I build custom engineering. And what is really, what we have not seen anybody do, like some might have a modular system, but they're going away from it. Like there's a company, ESS, who started with containers and they're now going to an energy warehouse. But I think the interesting thing is, and that is not yet seen much in the industry, is the ability to move your asset and decouple project lifetime from asset lifetime. Because right now they're always coupled. So you always have to somehow figure out, how does your asset make financial value, make profit at this location in the grid, in this configuration? And we're like, no, you just have to bet that there's demand somewhere, and then you can adjust over the years. And that combined with mass manufacturing to drive down cost and the flexibility, we don't see that from other competitors. If you look at Form, they have not built much that you can see. So it's always a bit interesting to see how they're doing. Their efficiency is lower, but they're more focusing on seasonal. If there's Highview in the UK who are doing liquid air energy storage, but large monolithic systems. So this combination, I think that we do is truly unique there.
Got it. Thank you so much, Justin. Over to you, Matt.
What about versus supercapacitor-based batteries?
Supercapacitor-based batteries are on the opposite end of the spectrum. So a supercapacitor is focused on providing a lot of power in a very short time. So if you want to accelerate fast in your car, then you use capacitors. If you want to drive a long distance in your car, you would use batteries, or if you think of the energy grid, you would increasingly use long duration energy storage. So in the future energy system, we will probably still see lithium-ion batteries, if not even supercapacitors on the grid, for these very, very short-term stabilization of the grid. Somebody starts up a big machine in a large industrial facility. There you would have a supercapacitor to help you with this sudden peak of power, but then to shift large amounts of energy, that's what you need different technologies for.
How do you guys compare to lithium ion in terms of cost per storage? So for instance, we invested in a supercapacitor based battery system that has smart Basically, it combines the best of supercapacitors and lithium ion. So you have the same energy density, but 100x the power density and costs about half. How do you guys come out cost-wise? And doesn't degrade, which is the biggest problem really with lithium ion is you get 1,000 cycles and then you just start to go downhill from there.
So from a cost perspective, like there's two aspects to that. One is, of course, at what point of scaling are we? What kind of mass manufacturing are we? Because nobody has scaled this technology yet. So there's a lot of low-hanging fruits to reduce costs very quickly in the beginning. We can very quickly reach cumulative costs of less than 100 euros or $100 per kilowatt hour. But the longer the duration of the project, the more we are cheaper. Because that lithium, you might pay so if you make a lithium go from 1 hour to 2 hours of capacity, you might pay effectively 1.8 times as much. Versus if we increase the duration, you pay maybe 10% more or 20% more. So if you have a need for 12 hours, 15 hours, 18 hours, that's where all of a sudden the gap widens. Like the longer the duration, the bigger the gap between lithium and us. And from a component level cost, we can reach less than 50, probably even less than 30 euros per kilowatt hour on the energy side.
Oops. Is that changing cost or that growing gap due to the degradation of the lithium ion batteries is what I'm asking. Because if that degradation doesn't exist and the batteries then were able to stay fully charged without any type of kind of degradation, or they could last longer, then cost-wise, you guys wouldn't be improving versus lithium, would you? Or versus a kind of combo system?
It's a bit different. You can imagine a lithium-ion battery as thinking of, okay, lithium-ion battery always contains the motor and the battery of an electric car. Whereas in a supercapacitor case, you have mainly the motor, and normally, unless you have a special technology that you have invested in, a tiny battery. And in our case, you have a large battery and a tiny motor. But for us, the cost to increase the battery without adjusting the motor is super low. Whereas it's lithium, you always get both combined, because in an electrochemical cell, you can adjust how much power, how much capacity you get, but you always have the cell. So there's a fixed cost. If you want more power or more capacity, it's always the same cost with lithium. Okay. For us, it's less cost to increase the capacity. So it's independent of the degradation.
Okay. And how do you plan to go to market?
We have a very high pain point of currently in Europe on the industrial side. Industrial consumers are looking left and right how to reduce their energy procurement costs. And that can be done with energy storage, both for the peak shaving demand, but as well for shifting large amounts of energy to times of where there's a lot of renewables in Europe, because that's usually where the prices are low. We have certain leads there. We have the first pilot system, but for the scalable case, we are already talking with an Austrian utility with whom we are doing a feasibility study. It's a paid feasibility study to build up to 7 first units in a renewable setting. So co-locating it with PV, with hydropower to help them generate more revenues. Because of course, for them, they're not earning money. If everybody has sun, the market prices are dropping to zero. That's not interesting. But if you have a storage, all of a sudden you can make a lot more money. So for the scalable case, we co-locate with renewables because that's a very homogeneous and scalable case. Once you understand how to put it next to a PV field, you can do that with every other PV field that you see.
I'm curious, Justin, what challenges are you anticipating to face over the next 12 to 24 months?
I think from also looking back now, we are 2 years in the game. We have so successfully raised 1.2 million euros in pre-seed money to date, and around 500K in non-dilutive capital. And I think in the last 1.5 years, especially, supply chain was a big issue. We're happy now that all the parts are in and they're in the lab and they're integrated and the system is being commissioned as we speak, but still getting components actually delivered is a challenge. Finding the right people will be a challenge, but we have good cards and have so far succeeded there. But also, of course, then achieving these milestones to actually build the system and achieve the economic milestones. So getting more contracts in. The more we have achieved on the tech side and to enable trust from customers, we will be able to sign more. But of course, it's an uphill battle as a startup with a big industrial solution as a proposal to sign early on commitments from customers.
Helpful. Thank you so much, Justin.
What do you need to get to be able to get those commitments from customers? Is it after the first pilot and case study, then you can start selling, or how do you plan on really rolling that up or scaling that up?
Yeah, what we're doing now is we go directly from the lab scale to a commercial scale with our first customer. And we have that first customer already really close. So they are really committed. They're also invested in us in a small amount. And we can build this first system at their premises, which is super valuable because that will already show in a megawatt range, okay, those folks can actually build a system in that range and it will work. What we need to answer your question directly of how do we get more commitments, the sales cycles are quite long. So oftentimes customers want the product delivered 2 years, 3 years, 5 years down the road, possibly, of initial contact. And having the commercial traction, but then having a lot of the understanding of how to actually make money with it. That is the second big aspect that we have in-house, because we started with how do you make money with energy storage? So we have a software tool in-house developed that allows to understand what is actually the business case? What is the right technology? It might not even be us, but how do you size it so that your customer makes money also depending on how the market might change? And that is really unique because most competitors that we speak with, they know very much about their product, but how to really make money with it, that's something that not that many really understand. And that's what will open us doors, because we can tell the customer, if you get this, this is how much money you will make with the system. And that is not as easy to do because you need to actually understand how to shift the energy in a profitable way on the market.
One of the potential challenges I see, everything in the world is going one of two ways. It's going Apple or Android. Either you pay premium for the things you love, or the rest is toilet paper and you couldn't care what the brand is as long as it's cheap and does the job. And with energy storage, I'm pretty sure it's going to fall into the latter of I want the cheapest, most effective solution. And if this is slightly cheaper than that, et cetera, I'm going to switch. How do you deal with that challenge? Because for industrials, for customers, they could give, excuse the French, they could give two shits what type of energy storage you use. If you're storing this by having things float, or if you're having whatever happen, or you have an anti-gravity machine and that's how you're storing the energy, great. As long as it's cheap, I'll take it. And it's environmentally friendly, I'll take it.
You said it at the end there, as long as it's environmentally friendly, as long as it doesn't have any fire hazard risks. We have talked extensively with Californian community choice aggregators. They can't build lithium sometimes because of fire hazard risks. If you talk about project financing, with the big guys like Allianz Global Investors, etc., who are at the other end of the financial pipeline that pays for these projects, they need solid ESG criteria in their projects now, and you need to have those sorted out. Now, we focus on being cheap. We focus on being more flexible, because you might be cheap, but if you build a system and that is not movable, you have it at this location, and it might have been cheap in the beginning, but we offer the customer to actually go from a CapEx perspective to an OpEx perspective. And that can be a big unlock for many who don't want or can't spend the big CapEx, because they can just get a subscription for a couple of years on energy storage. And then for us, it's okay if they don't want it or need it, because we can always ship it to a different customer. So driving down costs, scaling up so that we have more scale of production, reducing costs that way, and providing more flexibility to customers, plus being a safer and ESG compatible product, I think is then what will also help us defend it. Okay.
Pratibha, any last points?
Yeah, I'm just curious about your funding round right now. You said that you have about 1.2 million committed. So I'm curious what's the timeline to close? What are you looking for? And what are the terms?
So we are in the middle of the fundraising. We have talked with investors. We have seen good interest in it. I think one of the things with us is that we are still early stage overall. Still, we need to get over this capital, a mountain of capital in a way, to unlock really the scalable case. And I think from a timing perspective, it's very soon. So in like early Q1 next year, where we will close. And from a terms perspective, we believe that the market sets the terms. So we're happy to discuss that with investors directly.
Thanks. Thanks,
Which
Matt.
means the longer you wait, the worse your terms get. Unfortunately, just the way the market's going. Justin, thank you. Thank you so much for pitching. Thanks for presenting what you guys are doing. It's a very cool solution. Glad to have it here on the Startup Tank. Here, we got to throw our little plug in. Guys, this is the Startup Tank.
Thank you very much.
If this is your first time tuning in, oh no, I just clicked the wrong button. Oops. Well, we're going to have to get Pratibha back. I just bumped her out of the meeting on accident instead of getting rid of the spotlight. Well, now I'm going to need to talk a little bit more. So this is the Startup Tank, where we have the world's most interesting and action-oriented climate startups on. We do pre-seed to Series A, and we try to make sure that the companies, they move the world forward. That's what we're looking for at 4WARD.VC, our climate syndicate and climate accelerator. I'm talking a little bit because I got to get Pratibha back in here quick. But if you guys want to learn more about us and what we do, thestartuptank.com for more details and to apply and to learn more about our partner in crime program, because all VCs say their value add. And generally speaking, that means they say their value add, and that's kind of the extent of that. Or they're really taking in big cohorts for accelerators. They have deadlines. They're not really reliable. Or, hey, guess what? Our cohort just ended, but in 6 months, we'll have the next one. So if you put your company and your life on hold for 6 months, then we'd love to work together. That seems like the wrong way to do things. So we're reinventing that. If you want to learn more about us and how we do that and why we do that, 4WARD.VC/accelerator. And now I would do another ad while I'm waiting for Pratibha to hopefully get back in here. So the Startup Tank, we're brought to you guys by the Yugen agency. If you haven't heard, they're the go-to agency for climate companies that are looking to not only have great branding and sales, but also really be able to crush it on their raise and with looking professional for large-scale customers like those industrials that we're talking about. If you want to learn more about them and what they do, 4WARD.VC/design. That's DESIGN, obviously, to get more details. Companies pitching here will have our startup of the night. We'll get 5,000 in credits towards design services from them, and all the other presenting companies will get a special feature one-on-one, kind of unlocking the brand and trying to help them with positioning for racing their round. On top of that, we're brought to you guys by Carta and Valbon. Carta is probably the largest player in the venture space now. Valbon's the service we love for setting up SPVs. If you haven't checked them out, make sure you do. 4WARD.VC/Carta, that's CARTA, for more details and to set up your SPV or to manage your cap table or whatever you need on the startup or venture or ESOP or employee management side. Carta's got you covered. It looks like I'm going to have to jump to the next company now. I really hope Pratibha comes back. Sorry about the glitch on my side, guys. I would hand things over now to Sala and Sonal from Solaires, who are trying to reinvent the way we do solar by making it a little bit more flexible. Pun intended.
Thank you, Matt. I'll share my screen with you all. Are you able to see my screen?
Yes, we see your screen.
Awesome. Imagine if we could capture the sun's energy from anywhere, from windows, building facades, electric vehicles, or cell phone cases. However, the technology we use today is not suitable. We need a new material and technology to fulfill the requirements for those applications. Let me explain. Solar cells consist of multiple layers around a semiconductor. The most popular semiconductor used today is silicon. In order to create the next generation of solar cells, dozens of tier 1 companies are trying to replace silicon with a perovskite using an ink printing process. However, no one has been able to commercialize perovskite-based solar cells as of today. At Solaire, we enable the photovoltaic industry to mass-produce perovskite solar cells with a reliable perovskite ink, which has a much higher energy conversion efficiency and a more affordable, simpler, and shorter value chain compared to silicon. Also, perovskite has potential for double the energy conversion efficiency of silicon. A unique use case of our technology is to allow IoT devices, like phones and smartwatches, to capture energy from indoor light. Imagine that in the near future, any device that uses a battery will be able to recharge on indoor or outdoor lights. This is a $768 billion market. This is a huge market opportunity, and our goal is to own the market by 2027. Our solar ink has a long shelf life, provides high efficiency, and is compatible with different scalable manufacturing processes used by the industry. There are only 2 other companies marketing perovskite ink. However, their ink is only suitable for research and small-sized coating processes. Our competitors are facing a significant challenge. The current perovskite ink has only a couple of days shelf life. This means that it's not suitable for mass production and is not commercially viable. At this time, our ink is the only one to pass the 3-month stability mark. Our perovskite ink is the first step of a larger project to develop in the future our own flexible light solar panels that can be installed on any surface, such as electric vehicles or phone cases. We have multiple revenue streams that include the sales of our solar ink, consulting with customers, licensing and royalties from our manufacturing process, and also in the future, we may plan on selling our own perovskite film too. We have a comprehensive sales process where our sales executives are working on 150 leads on a weighted sales pipeline of over $4 million. As of today, we have sent our ink to 19 customers around the globe. Today, we have signed a letter of intent with our partner, Bright Solar, a statement of work with Koyaku in the US and ZAR in the UK, and an ink distribution agreement with iTech in South Korea. This is an actual prototype of a perovskite solar cell made by our partner, Bright Solar. They are a large, well-established European company. We are currently working with them to provide them with perovskite ink that will help them scale to mass production by the end of this year. We have a comprehensive IP strategy that includes protecting 44 innovations. Our patent filings include in-licensing, granted, and pending patents. Our patent applications cover our core technology, future product iterations, and the adjacent market space. Customers are excited about our product. Solaire has won multiple competitions, including Canada's Clean 50 Top Projects, Top Startup Canada, Douglas 10 to Watch. We have been featured as emerging markets by the investment community in BC, and Foresight named Solaire one of Canada's most investable tech companies. Let me tell you about our team. Dr. Sahar Sam invented a fabrication process for 10-film solar cells. Our co-founder and CEO, Fabian De La Fuente, is a 5-time serial entrepreneur with over 100 patents under his belt. And our chief development officer has over 25 years of experience in scaling coating technologies, having worked with ZAR, Creo, and Thai American. Just for our ink, we forecast $34 million cumulative revenue by January of 2027, and our EBITDA to be positive by 2024. Next year, we are projecting $300,000 as a result of our solar ink sales, and in 2025, we will activate new revenue streams from licensing our manufacturing process. We recently closed our pre-seed round. To date, we have raised over $7 million in equity and non-dilutive funding. After this round, we're planning a seed round to start in Q2 of 2023 to scale up our manufacturing process. We are planning to exit by acquisition in 5 to 6 years. Potential acquirers in the market include current players in perovskite market, as well as companies
Time
in the
is up.
industry. Thank you.
Pratibha, I'm so sorry about kicking you out. I was trying to add
No worries.
change the presenting mode. Thank you so much for presenting, Salah, and sharing what you guys are doing with Solaires. I will probably handle most of these questions, and if you have anything you want to add there on top as well, then go for it, Pratibha. But my first question for you would be, how large do you see the actual perovskite and solar ink market being, and why?
So right now we're seeing it at like the overall market is going to be around 700 billion by 2027. But for perovskites, I think, and what we're trying to do, I think the overall is going to be about 8 billion by 2027. And the reason is this includes any flexible solar panels. Currently, there exists a lot of other alternatives to silicon, but they're not as efficient and they're not as scalable. And what we're doing here is we're providing a technology that could be more efficient, cheaper, and allows for these like innovative applications that silicon doesn't. So it'll easily take over that market. What we're aiming for is to have a sum of 325 million.
Okay, understood. And you're planning on building and manufacturing the panels yourself then as kind of the next stage?
Yeah, so step one right now is we make the ink and we sell it to manufacturers who are already doing flexible panels maybe and rigid panels because you can make rigid panels with the ink. It's just replacing the silicon with the ink. And then the next stage is developing our own manufacturing process and then licensing that to those manufacturers or new players that want to go into the solar industry. And then after that, we might develop our own solar film that can be flexible and has some translucency features to it. So that's the plan.
So you think you can develop better solar panels than the folks who've been doing it for a while?
Yes, we think we can because this is a new technology and we're the ones who are like pioneering this.
And you're
market.
targeting a 5 to 6 year exit?
Yes, that's the plan.
Why is that the plan?
So we're hoping to target that because we'll have enough revenue to be valued at $1 billion hopefully by then, and we'll create a lot of returns for investors. And hopefully we're expecting to get bought out by one of those large players that have been doing solar for a while. And hopefully they can continue scaling the technology further.
How big can you build this in 5 to 6 years? That's one challenge I see is whenever founders say, we want to build this and exit, it's kind of like saying, I want to marry this girl and then have some new options in 6 or 7 years. It's not going to turn into anything super serious.
Oh, we're taking it very seriously. It's just we're being a bit more, I think, realistic with the big players out there. They've been around. They do a lot of different technologies involved in a lot of different areas of the value chain for solar. So we think it is better to work with them on developing this technology. And of course, if in the future we see a capability to do our own thing and grow this to something even bigger, we will go with that. But so far, most of our advancements have been the result of us working with partners on testing the technology, and that's where we're foreseeing going. We'll continue testing it with different players, and eventually we will be testing it with one of those potential acquirers, and they will obviously want to express interest in maybe acquiring us. So we're just being a bit more realistic there.
Pratibha, do you have any questions from what you were able to see? Sorry about that again.
No, no worries. And I was literally at the tail end of this presentation, so apologies if you've covered this. Like, just curious, what are your key milestones that you're looking to achieve over the next 12 to 18 months, leave alone the next 5-6 years of the success that you're anticipating? 12 to 18 months, what are the key milestones you're looking to see as success?
So I would say our key milestones for that time period would be to have helped our partner Bright Solar create those scalable rigid panels, partner with another company, which we're having discussions now and evaluating some options that makes flexible panels as well, and take that to scale with them too, so they're able to create industry standard size scalable flexible panels using our ink, and also to develop our own manufacturing process by the end of those 18 months. I hope that answers your question, Pratibha.
No, that's helpful. Thank you, Saleh.
And for that timeline that you have, your goal for 2027, how much capital do you need to reach that and to reach scale? How much more are you going to have to raise?
So we're expecting having to raise anywhere between, from now to 2027, anywhere between 30 to 40 million, I think. As you know, it's very extensive like research that we have to do, and we're hoping to have positive EBITDA by 2020, by end of 2023 or early 2024. So hopefully we'll start matching that and scaling. But just to take it to the next level, I think those would be the numbers. So seed round of 5 million, then Series A maybe 10 million, and maybe a 20 million Series B.
And if you fail, why will it be?
If we fail, I think the main reason would be not being able to get the funding needed, just because we're a bit more deep tech and it does take more cash to help us develop the technology and prove it out. But I will say, as I mentioned, none of our competitors have been able to stabilize this ink in the past 10 years for more than a week, and we've already achieved over 3 months stability. And this is for the ink to be applied on the panels. Once it's in the panels and encapsulated, it lasts for a much longer time period. So we've been on the trajectory for success so far in this industry. So we're very hopeful.
Very cool. Very cool. Well, thanks for taking the time to present. Thanks for everything that you guys are doing. It's clearly necessary. We need more renewable capacity. I almost removed you again, Pratibha. Geez, I need to make sure I'm careful with the buttons. Careful with the buttons. We'll just do this the easy way. If you guys haven't subscribed yet, by the way, hit that subscribe bell on YouTube. If you're on YouTube, we're also on all the major podcasting platforms. It'd be great if you guys subscribed, left a review, even just to help spike the algorithms a little bit. We all know how the platforms work. Spiking the algorithms is a great way to get in front of more climate companies, more climate investors, and to get more great climate companies like these guys a little bit more exposure with the guys who might just write them a check. We've been doing a lot of energy. We did sun's hot. Well, now why don't we go on the cold side of things? This one's a cool one. ChillTech and Alex. Alex, do you want to take things away and tell us how you're making the world a little cooler without almost energy free? It's pretty interesting stuff what you guys are doing. Alex, you ready to rock?
Yes, hi. Can you hear me? Can you hear me okay?
Yeah, let me pull the rest of us out of here and make sure it's just you. And then you should be able to share your screen. Let me know when you're ready, and then we can start the 5 minutes, and you can take it away.
Okay. Have you ever thought about the impact of something we all take for granted, cooling and refrigeration, or perhaps the impact of having to do without it? The world is facing a triple crisis today. But we're going to need much more cooling and refrigeration as things get hotter, plus stickily high energy and food prices as supply chains are disrupted and recalibrated in a post-globalization world order. In the global south, where a very significant part of all power is supplied by diesel generators, it is simply too expensive to power cooling or refrigeration equipment. It's actually cheaper to accept food loss levels in the supply chain for perishable foods of as much as 65%. All of this is, of course, catastrophic for the rural economy, people's health, and for the planet, because spoiled food rots down and produces methane, which has a global warming potential 28 times that of CO2. In fact, according to the FAO, if food loss were a country, as you see here, it would be the 5th largest producer of GHGs at 1.8 gigatons per annum. Another inconvenient truth is that all engines are fundamentally inefficient, around 30%. In that the majority of the energy input is simply turned into heat, most of which is then lost in the exhaust. What if, by harnessing that waste heat, we could eliminate the operational cost of cooling and at the same time eliminate the emissions associated with burning fuel to power cooling equipment, and very high levels of food loss. This is what we do at ChillTech. We're a London-based company with patented technology allowing us to deliver cooling free at the point of use, with zero fuel cost and zero carbon impact. We do this by using the waste heat of the engine or generator as the heat source to power an absorption chiller, the unit which produces the chilled water for air conditioning or refrigeration. Our patents center on the design of a more efficient absorption system, which allows us to use direct waste heat. We don't have to go via hot water or steam to generate the cooling, unlike other technologies. This reduces cost, complexity, and footprint, making our technology deployable in smaller sizes, and is why, crucially, we can make it work for cooling in refrigerated transportation. Standard transport refrigeration units, TRUs, use at least 9,000 litres of diesel per annum. Our technology completely eliminates this cost, thereby solving the usual conundrum of climate tech, which is how to make it pay for itself and benefit the user, while benefiting the planet by delivering decarbonization in the supply. The fuel savings are similar for our static chillers, where electrical chilling is provided from a diesel genset in the base case. Importantly, we also use a natural refrigerant, ammonia, which has zero global warming potential, unlike HFCs and HFO refrigerants, which must be phased out by 2047. Markets are cold chain, both cold storage and refrigerated transport, building cooling, hotels, schools, etc., microgrids, localized power, which is a major growth area in energy infrastructure, and temporary or leased power. All of our target markets are forecast to see robust growth over the coming years, but the biggest impact opportunity lies in the global south. Our technology will catalyze adoption of the cold chain, where there is almost none today. Extrapolating cold chain assets per capita in the EU or US to Africa and India alone implies a potential market size of over 4 million refrigerated trucks and 1 million cold hubs. And that's based on today's population. As we make sales and our units are in the market, their use will also generate substantial amounts of carbon credits for all the emissions they will prevent. One of our TRUs on a 40-foot trailer will conservatively save 350 tons of CO2 equivalent from being emitted each year in Africa or India, for example. The monetization of carbon credits is expected to generate a virtuous circle, allowing the company to reinvest carbon revenues to lower and eventually remove the CapEx barrier to entry by cooling as a service, CAT, thereby driving further adoption. There are carbon market price scenarios here you see on the right of the graph where such revenue really becomes the primary driver, although this is not our base case and we are not formally including it in our model. As for CAS, we intend to roll out this model where the user pays a monthly use fee, assuming they're bankable. As you probably know, hardware servitization generally doubles the EBITDA margins over time. We're midway through a £1.5 million Series A round now and have just hired key production and commercial staff. We are market ready with our static chillers and soon to start field testing the TRU with our future customers in Africa under the IFC's Tech Emerge program. We'd be delighted to field any questions and to engage with viewers who would like to find out more. Thank you very much.
Awesome. It looks very cool, pun intended. So in terms of first questions, while bringing Pratibha back in here, what's your story? Why are you doing this? How did you get into this?
Well, it's a family story, actually. The chairman and CEO is one of my brothers. He's got a long history in startups, mostly in the TMT space, and also a background in the long-distant past in corporate finance. I'm historically a commodity trader, agricultural commodities, so I've been involved in the agricultural supply chain across the world, really, but mostly in Eastern and Western Europe for 22 years before branching out into startup land. This is my second foray into upcycling and recycling and waste reduction. I had a startup in the insect protein space, upcycling fruit and vegetable waste. A bit early to the party there, unfortunately, but that's where I got interested in the carbon market, and I really like the intersection of commodity markets, which carbon is becoming, and in carbon finance, which is going to help drive this the decarbonisation and really catalyse the cold chain in the global south.
Why did you choose the cold chain? Why cold delivery versus, for instance, the most of the world is starting to want to put in AC and HVAC units, potentially having your oven power your air conditioner at home so that India doesn't have to suffer through terrible summers without AC.
No, I mean it's definitely it's one of our verticals here that you see. I'm still sharing my screen. I think I am, maybe not. Building cooling was the original use case of this technology. In fact, it was AC, but actually the catalyst to get us to focus on the cold chain was actually brought by the IFC, the International Finance Corporation, part of the World Bank, who approached us. This was in the throes of COVID, actually, and said, "Hey, we've seen your technology. We think it can be put to very good use in the cold chain, static, cold rooms, cold stores, and more importantly, perhaps in the future, for refrigerated transportation." So it was really at their instigation that we went away over COVID when we weren't able to actually physically install any projects anyway because you couldn't travel. Went away. Adapted the technology to a lower temperature range than aircon, and hence the deployment and the focus in the cold chain. Now that is, if you think about it, with what I just described, the cold chain is really where you get the most bang for your buck from an impact perspective, due to those levels of food waste and all the societal benefits that cascade from bringing the cold chain where there isn't any at the moment.
What percent of food waste is actually attributable to not having sufficient or requisite cold storage in the logistics system versus it's just taking too long, or people not eating the food, or something else happening that it goes bad?
Well, it's a good question. There are several stages in the supply chain in the fresh produce cold chain. We're in the pre-consumer stage, but ex-farm to market, right? And there are intermediate stage sub-stages in that supply chain. So we are, with our static chillers and the refrigerated transportation, we're looking to facilitate a hub and spoke model for the cold chain. And then, the start of the supply chain, the ex-farm level, there are other solutions which are complementary. At harvest time, the produce does need to be pre-cooled to get the harvest heat out. So if it's been harvested in the heat of the day, you really need, it's very key to get that temperature down, not to refrigerated levels, but just to get the say 30 to 20 degrees level. And there are many very good and very deployable solutions out there, mostly deploying solar boxes at the farm level. So we intervene after that to get it from the farm to the aggregation point, then in the aggregation point, so the cold store, right? And then there's probably usually there's another transport leg, either to domestic markets, and we would hope to have more cold stores using our technology in the main fresh produce market. And then if we're serving an export market, the export hubs, say in Tanzania, Kenya rather, for example, there are already being built state-of-the-art cold hubs at the export points, so Mombasa, Nairobi, etc.
Is the bigger opportunity with trucks or with ships?
Ships, we think there is an opportunity with ships, but we haven't tackled it yet. There's definitely, because there's a lot of, obviously there are huge engines burning marine fuel, which produce a lot of waste heat. But no, we haven't tackled that yet. The big opportunity, it's both. It's a hub and spoke model. You need the static and you need the refrigerated transportation. In terms of prospective customer feedback, I would say that the level of excitement is higher for the refrigerated transportation leg, because you're reducing. The reason there isn't any is because no one can afford the fuel. 9,000 litres of diesel a year is a lot of money, and the supply chain is just set up such that the ex-farm price is depressed, reflecting the level of loss which is inherent in ambient transportation. So if we take that out, we're refrigerating it for nothing. It's a no-brainer for any merchant of fresh produce who's just by just sticking our unit on an insulated flatbed truck is immediately getting 20, 30, 40% more produce to market. It's an immediate boost to his bottom line.
So why are you still raising? Why is it not automatic already? Miles and miles. You had the IFC talks.
Matt, I'm sure you alluded to it earlier. I think even at the best of times, startup fundraising is not a simple process, and it hasn't gotten easier in recent months. But we have raised historically before this round. We had raised about £2 million, mostly equity, a bit of convertible debt, and as I said, we're halfway through this current Series A round. So we raised roughly £600,000. So we're about halfway through this.
Oh, that's a really small Series A.
Well, the nomenclature we were advised to call it Series A. I don't know what you call it.
Okay, 1.2 million is not a Series A that I know of.
You can best perhaps label it as pre-Series A for now. Yeah, no, I agree with you, Matt. Just a quick question, Alex, as you think about your regions of focus, these are, I'm just curious, what countries are you focusing right now and how are you looking to ramp out?
Yeah, good question. There's a blend. We're testing the initial focus, which is again directed by the IFC. They partnered us up with technology adopters in West Africa. So one is a Pan-African logistics company who wants to get into refrigerated transportation. It's currently just a regular ambient temperature logistics company, and the other is a grain and fertilizer handler who wants to get into cold stores and has process power on site, shedding heat, which we can use. So that's Africa. So initial focus is Africa, West and East, and we've just hired a commercial general manager for the African continent. But equally, and again, I was concentrating on that more from an impact perspective because that's obviously where the impact is concentrated. But meanwhile, we're also going to do a trial with a leading temporary and leased power operator in the UK on their hydrogen gensets in the new year. So that, if you like, is with an eye to future-proofing the technology in the unlikely event that diesel disappears, which I don't think anyone truly believes. But we can. The point is, we're trying to be heat source agnostic. Right? So if you've got hydrogen engines, we can use them, hydrogen gensets, we can use pyrolysis exhaust. We think we can use biomass burners as well. We haven't actually done it yet. But we're trying to be heat source agnostic to cover all bases. And the missing link in that respect, excuse me, my dog just wandered in. The missing link in that respect is solar. And we haven't figured that out yet, but we think we know how to do it, but we haven't done the R&D yet. So that's really that will be the holy grail covering all bases. For example, in a microgrid, any microgrid then could be plugged in to plug into any microgrid, which almost all of which still have a significant part of diesel today.
What about data centers? Oh, sorry, go ahead.
No, just one question before Matt. I love the question on data centers. Just curious, we are talking about quite a few local players in some of these markets that can really focus on addressing this pain point. What makes your technology different? And this speaks to the patent aspect of it. Like, what is the unique competitive edge that you present?
Well, there are several aspects to the patent, such as they are at the moment, and there will be more patents in the future, I believe, as new products are developed, notably the truck unit, which, despite being the same design as the static chiller, is a distinct it probably has some patentable aspects to it as well. But it's the direct capture of the waste heat. As I said, I was rattling through it a bit, but I alluded to it in my run through. We're capturing the exhaust, plugging straight into, if you like, a thermal box, which is the generator, which provides the power for the heat exchange. So that's one aspect. Other large-scale industrial chillers, they all go through steam or hot water to do that. So that's one aspect, and then there's the internal workings of our absorption process with multiple heat exchangers, and it's the overall thermal efficiency of the unit, which is pretty high. And then water, and then it's also air cooled, which is another aspect which is quite novel. Most are water cooled, which imply having a water tower, which obviously increases your infrastructure footprint quite significantly, and obviously would make refrigerated transportation using that pretty impractical.
Yeah. Okay. And what's the pricing model? Like how is your business model panning out at this?
Yeah, I mean, there's a basic. Our financial model is a simple B2B sales financial model, but there are two overlays to that, which we have not integrated. And again, I alluded to them in my run through. One is certification. So removing the barrier to adoption of CapEx, just turning it into a monthly fee. Obviously, that requires balance sheet or an SPV. It requires bankability. So it's not something we can say, hey, here's exactly the cash flows from the servitization model, which we're going to do. We have to start with B2B, simple sales, build a balance sheet, build bankability, and meanwhile cultivate counterparties who can provide that funding, and there are some. We've been talking to them already. So that's one overlay, the CAS, cooling as a service, and then the other one is carbon finance, which really can. I mean, I don't want to get too excited, but depending on what happens to the carbon price in the future, it could really become the tail wags the dog of our business, because you've got a very nice cumulative effect here, because each of our units, we think will have a 7 to 10 year lifespan. So as we sell more and more or deploy more and more on balance sheet, they keep on chugging away, keep on avoiding carbon, which is monetizable, and obviously that the vast majority of that revenue gets recycled into the business in order to drive adoption. Right? You have differentiated pricing in the global south, where you are generating those carbon credit revenues, versus in the developed world where you're just got a higher sticker price because you don't have any carbon revenue, right?
Yeah.
But that's all well and good. That's the function of carbon finance. That's what it should be doing.
Okay. Thank you so much, Alex. Matt, you were talking about data centers.
Yeah, data centers need a ton of energy. They get real hot, but they actually have to stay pretty cold. Could this not be something for data centers?
It could be. My brother's the expert on this. He has some experience with data centers from the previous life. But from what I understand, at least in the West, if you like, in the developed world, the liability that you have to enter into when you have a data center cooling contract is just simply too dangerous for a small company like us. I.e., if anything goes wrong, your liability is quite uncapped. There is, interestingly, a large data center project has come our way in Nigeria currently. So we have our ears open to it, but it's not an immediate focus.
Understood. And like you said before, and like we've said, there are definitely competitors on the market. I asked this question before, but I'll ask it again. If you fail, why will it be?
Did you ask me? No, you asked someone else that. Right?
No, I asked someone else that. I'm just curious what your answer is.
Funny enough, in the global south, the the biggest sort of existential risk to us is wholesale societal collapse, such that people aren't running their generators or trucks, so there's no waste heat to be had. If there's no waste heat to be had because things are so bad, and actually that by the way is a little bit the case in parts of Nigeria at the moment, and I think other parts of Africa soon, as the if the energy prices stay high, stickily high, that is a risk. But then, is the whole world going to stop? Probably not. And as I said, we do have these verticals which are applicable in the developed world as well. So we obviously don't want to do that, but if we were forced to, we could refocus away again from the developing world, but it'd be a shame.
How much capital do you need to get to hit scale?
Well, I mentioned a very impressive TAM of 4 million refrigerated vehicles. Obviously, we're not pretending that we're going to take over the world of refrigerated transportation. Our 6-year plan has us selling at the end of it 10,000 units a year, roughly split 50-50 between the static chillers and the refrigerated truck units. In order to become self-sustaining, according to our model, we will need, after this round, we'll need about £6 million of total funding. Now that's not pure equity, that's any source. So I hope it will be a significant part of that will be carbon pre-finance, and hopefully some debt funding for a CAS vehicle.
Or grants even. Awesome.
Or grants, indeed.
Well, Alex, thanks for sharing. I wanna move things along now to our last company of the night.
Thank you very much.
And if you guys are tuning in, it's your first time, thestartuptank.com for more about us and what we do and to apply to future sessions. We do this every 2 weeks. And I run 4WARD.VC. We're an early stage climate accelerator. We invest in companies that move the world forward, and we do it in a pretty unconventional way. If you want to learn more about us and what we do, it's just 4WARD.VC, investing in companies that move the world forward. And I think Madison's definitely doing that with Mount. I was super skeptical when I initially saw the pitch in the deck, and I was very impressed when I got deeper into it. Do you want to take things away and talk about the Airbnb of amenities, so to speak, Madison?
Happy to, yeah. Let me share my screen. Perfect. Is that working for everyone? Cool. I'll jump right in then. Thanks for having me. My name's Maddie. I'm the co-founder and CEO of Mount, and essentially we're a software platform that allows you to rent anything at any time to anyone. Now, the shared economy is massive, and that was a really broad statement. So where Mount decided to root ourselves was in the travel industry, and specifically within the Airbnb market. And it's really the fact that amenity-based revenue and really other revenue streams are really hard to tap into. For example, your classic Airbnb host is making 99% of their revenue directly from bookings. So that means they don't really have the opportunity to capitalize on the guests when they're staying at their property. And this was really hard fact to come to terms with during COVID-19, when these hosts lost 65% of their bookings and they could no longer run a profitable business. So Mount dug into the problem a little more and understands now that travelers are currently paying for upsells. 83% of the worldwide travel community is actively seeking out these experiences, these fun things to do when you travel, these local experiences, and they're paying for them to the tune of $9.2 billion. So that's how much is currently spent every year by these travelers, just for amenities, for experiences, activities. And that's all the stuff the host really can't get access to. So the Mount solution, our platform, is what we've created to give these hosts access to that revenue. We can take essentially everything else they own other than the house, and we turn it into a rentable amenity for travelers. So we simply put on a GPS tracker QR code onto the amenity, take a golf cart, for example, a kayak, a paddleboard, you name it. It becomes a rentable amenity with our technology. And then when the guest shows up, they download the Mount app and they can see everything they can possibly rent, and they can rent it within the app. So the reason why Mount is so unique and is caught fire in this industry is for 3 reasons. First of all, we have a transactional app. So currently the way an Airbnb host, a short-term rental host would do this if they wanted to, is they could put a bike on their property and try and offer it to their guests. But they would have to either ask you for a cash compensation, which is hard because a lot of these hosts never greet you in person, or they'd have to ask you what your Venmo is and trust that you pay them. So Mount created a payment solution within our app so that the guests can do it on site. We also created a custom-built insurance policy. So this is a huge reason why hosts don't do this themselves. And this insurance policy covers all of the injury liability. So if you list a bike and someone hurts themselves via a Mount rental, that part of it is covered. That insurance policy is impossible to get as an individual, which is why Airbnb hosts can't do this. Or if they do luck out and get through the process, they're spending $100,000 a year for that policy to rent one bike, and they'll never see a profit. Our last really game changer with Mount is our GPS tracking component. So everything a host lists on our platform is GPS tracked, so they know where it's going, when it's coming back, and in what condition. So that way they can have a peace of mind if they're listing a $20,000, $30,000 golf cart, they know when it's coming back and how that guest is treating it. So the market is actually quite massive. This is a market breakdown based on amenities and the revenue they generate. So the initial market we're starting is within the United States, a $2.5 billion market for Mount. And when you open it up globally, looking at $115 billion. And that's just within the short-term rental industry. You'll see later why Mount is so unique. Our business model is quite interesting. We take money from two customers. We charge $15 a month per host to the host per amenity. So a SaaS fee essentially, and they get access to the insurance, the payment tools, and all the value I just mentioned. And then on top of that, we add a 20% service fee to the rental. So if the host puts $10 an hour, the guest will rent it for $12, and that's where our fee is coming from. Now, the biggest objection we've gotten so far is that the Airbnb market is dispersed. There's 7 million hosts worldwide. How on earth are we going to find them all? So we have 2 points of attack.
1 minute warning.
Yeah, I got you. Our first is our social media influencers. So these people teach hundreds of thousands of hosts how to do what they've done because they're quite successful. And we got in contact with a few, went viral in a Facebook group, and actually got 10,000 properties signed up on our waitlist in the last few months. That encompasses 46 different countries, proving Mount is a global needed solution. Now, our larger scalable strategy has to do with the software tech stack already in our industry, Airbnb being one of them, but hundreds of companies beneath that. We integrate with them, and that's how we get access to our 7 million properties and hosts globally. At a flip of a switch, they all get instant access to list Mount amenities. So we are going after a massive industry, starting with hospitality, but as it turns out, every piece of private property needs rentable amenities. So going into office, multifamily, and retail. So thank you so much, and happy to answer any questions.
Awesome. And thank you for sharing, Madison. It's a super interesting. I know this would definitely have been helpful for our trip to Greece, and I'm pretty sure everybody can relate here. Let me pull in Pratibha and myself. And Pratibha, do you want to take things away? What questions you have for Mount?
Firstly, thank you so much, Madison. Great pitch. Just and love the whole reuse economy angle. Curious about your theory of change or impact. Could you speak to a bit about what is your vision for the kind of environmental impact you are looking to achieve through, or social impact, if you will, through your company?
Yeah, fantastic question. So really the Mount vision, and you'll actually see this if you go on our website, is in the next 5 years, getting this travel demographic of people to really travel with a backpack and then rent everything they need in destination, from their purse to a ball gown they might need for a wedding, to the bike. So really everything. And that way we can reduce this term we've coined called single-use travel, where, you know, we were actually in Hawaii for 3 months and we had the local travel economy showing up and then purchasing those inflatable floaties, using them for 5 days, and then throwing them away. And the cycle continued from there. Yeah. And it really is dependent on each market, but that single-use travel is kind of destroying, I guess, the environment. So that's what we're trying to get people away from doing.
Great. And curious on what makes you and your co-founder the unique folks to be able to tackle this problem?
Another good one. So I guess it didn't come across in the 5-minute pitch because limited time, but I have been doing Mount since I was 12 years old. So I started on this journey. It was a bike lock company. And then with a string of 8 to 9 pivots over the last 12-ish years, kind of have landed in this amazing shared economy where there was an actual problem. I would say bike locks, not so much. But because of that and that journey where I actually met my co-founder a few years ago, and we've kind of been persistent and on this journey, that would make us kind of unique to do this and solve this problem. And then along the way, have met many industry experts that are now backing Mount, working for Mount. We're a full-time team of 10 right now to kind of grow this and take it to the next level.
Love the passion here, Madison. And I know of the space pretty well. We've made a couple of investments in the reuse space. Just curious about how are you thinking about the comps within the market that are attempting a version of this, right? Like you have some that are looking at parents, the moms, the use for children's equipment and amenities. Some are looking at the office space and looking at how you could be reusing furniture, and the others. Like where do you play, and what's your closest comparable in the market?
Yeah, so I think it's a great question, because the shared economy has been around for upwards of 12 years now. I think in the recent years it's become quite popular and more widely adopted, so people are willing to rent things from each other. But when we look at our competitors, a lot of them have already failed and don't exist anymore. One called Ruckify, another called Fat Llama, which is actually based in the UK. They took the very opposite approach of Mount, where they decided to tackle the entire shared economy at once. So basically rooting it within communities, which is a very vague word. And you could rent a saw, a bike, like literally anything. And they failed because they didn't root that shared economy in something. And it's kind of, you're not going to get enough people that need to rent a saw and then also a bike. And it's just, you're not going to get enough usage. The reason Mount is quite different is because we rooted it in travel within a shared economy that already existed, which is Airbnb. So what we found is these travelers show up and they want to rent a bike. They're doing it already. We're just making it a lot more convenient. So our utilization is pretty high. So in that sense, I'm not too worried about our competitors. And then if you look directly in the short-term rental industry, we're actually the only company doing what we're doing right now, rooted in technology. The other shared economies have to facilitate it with people. So if you want to list, your lawnmower for rent, you have to be there to facilitate it, and it's not a full-time job. With Mount, everything is self-service. So you can list that lawnmower and you don't have to be there when it's being rented. So a lot of differences.
Got it. And the last question before I just hand it over to Matt, over the next 12 to 18 months, what are your key milestones you're looking to achieve?
So we are in the tail end of closing our proper seed raise. So we were raising 2, became oversubscribed. Now we're closing 3 million. We have about 500,000 left. Closing that by the end of this year, and then using that money, we have a few key hires we want to make with those milestones. So one being a customer success kind of head that can build that team out, really building our sales team out because our software is in a place where it's ready to be utilized. And over the next 12 to 18 months, really growing our revenue, hitting anywhere from 4,000 to 8,000 amenities on the platform that are live and being used, getting us in a position where we can raise a solid Series A, potentially hitting $1 million in transaction volume every month on the platform. That's kind of our North Star. And really proving out within this kind of smaller 4,000 to 8,000 amenities that Mount is a profitable business model. We can raise that Series A and then just really grow from there.
Thank you, Madison. Over to you, Matt.
Are you a business or an Airbnb feature?
I would say 100% a business. And we like to say that we're finishing what Airbnb started.
They started to do this and then kind of gave up due to COVID because they had to cut back on headcount. Are you worried that they will then implement what you guys are doing once they start to have things running a bit smoother at the Airbnb headquarters?
No, and there's a few reasons. One of our investors is General Catalyst, so we have pretty close ties to Airbnb as it is because they were early investors there. Through a lot of research and conversations, Brian, the founder of Airbnb, his grand vision was to incorporate this. And as you just mentioned, they tried and failed with Airbnb experiences. The reason they failed so miserably, in my opinion, is that they didn't tie the two platforms together. So if you rented an Airbnb you kind of had to go do your own research and figure out what an experience was you should be. And then they didn't vet any of the experiences. Like I did one in Portugal, thought I was getting a local for a bike experience, and turns out he was, fresh from Hungary and had never been to Portugal before. So it was kind of a weird experience. So they lost a lot of credibility. The reason they're not going to continue down that path and they're not going to do what Mount is doing is because Mount comes down to being asset management. The goal is to have over 100,000 amenities on our platform, handling that customer service and making sure it's a humming business. Airbnb doesn't want to take on the management of 100,000 assets when they're already working with 7 million hosts and properties. So they're going to stick with their bread and butter, which is properties and that growth. We're going to stick with ours, hopefully grow together. We have a partnership with them in the works. But I don't see them doing what we're doing.
Can you get General Catalyst to connect you to what's his name as an advisor?
Brian?
Yeah, if you can get them inbred into the company, that would be a good way for them to either eventually acquire you guys or hopefully not knock you off.
Exactly. And what I've done too is I took it a step further. So Airbnb has 4 or 5 main competitors: Airbnb, Hopper, VRBO, and then Booking.com. They're all kind of racing to market to figure out who can get the best share. I pit them all against each other. So we actually have investors and advisors from a lot of those companies, so that Airbnb doesn't own Mount in sense of lording over us, but we have pinned their competitors against each other to see who can work with Mount the fastest.
Network effects are great, except when you have to build them. And they're phenomenal, except when you have to build them internationally. So the Airbnb was almost a miracle in that it worked, because you have to have it work when you go somewhere else, which means you have to have it work everywhere. Otherwise, it's not something. How do you handle that? Are you going just directly after market by market, onboarding the Airbnb host, and the hosts onboard the users?
So not going market by market. We took a very similar growth approach to Airbnb, where we hooked into their network and basically created a referral program. So once we work with a host in Denver, they basically go and sign up all the hosts in Denver, so you can capture a market pretty quickly and they get that referral revenue. But in my pitch, I did mention we went viral in the industry. It's actually through conferences. That's how you meet everyone. That's how we signed up those 10,000 properties over 46 different countries. So we have in our growth model, we're prepared to go international pretty quickly for that reason. It's what Airbnb did, actually, I think unintentionally, but it worked for them. So it's in our model as well.
But how many amenities do you need per market for that to be able to be something feasible? So it's not just you can start, you've got to have enough for it to be worthwhile. Otherwise, it's a party with all guys or all girls. It's not interesting for the other side.
No, so actually that's not how Mount works, because technically, if you have amenities at one property, there's travelers coming directly to that property, and that host is telling them ahead of time, hey, this property has Mount amenities, rent and use them. So we actually have markets where we have 1 to 2 properties. It's Missouri, really random one. But, the travelers are coming to that property. That property is booked on average 65% of the time. So our utilization and customers are kind of built in. It's the reason we went with Airbnbs and hospitality to begin with. You don't have to go find travelers. They're showing up to the amenities.
No, it's very cool.
And quick question, Madison, how much are you looking to raise in total to hit the kind of profitability or sustainable business that you are envisioning?
So yeah, as I said, we're closing the 3 million right now. The target for our Series A is around an $8 million to $10 million round. And then from there, we should be able to prove out profitability and kind of just grow from there. So we'll see after that Series A how big we want to get and how much more money we want to pump in, but that is the target.
And what is the yellow flags that you are anticipating over the 12 to 24 months, given turn in macro conditions and how, as economic headwinds are starting to surface, travel can get potentially impacted?
Yeah, I would say it's a yellow-ish green flag, because the recession and the looming, market is exciting to Mount, because that's how Airbnb started. And it's why this new trend was created, was because people wanted a cheaper way to travel, not hotels. That's why Airbnb existed. And then also on the flip side, people needed more income streams. So the exact same thing is happening again, although it's not how do I become a host? It's how do I make more revenue per door? And for the last 5 to 6 years, everyone has been asking themselves, how do I get more doors? And now that's not the opportunity. It's more revenue. And Mount is the only answer to that question in our industry right now. And so that's why the next 12 to 18 months are so crucial, is we need to capitalize on, you know, the demand of what people are demanding Mount, and we need to capitalize on it.
Thank you.
And if you fail, why will it be?
I would say it's because we wouldn't be able to move fast enough and have enough people in place to capitalize on that demand. Because, you know, if you don't capitalize on the demand, wait 18 months, it might not be there. People might have moved on to the next thing. So the next year and a half will be crucial for us.
How do you handle the Uber problem of anyone can enter every market and put up a fight as long as they have enough cash to burn?
Like the professionalization of it?
Not the professionalization. So there was Uber and there was Lyft, and then there were like 1,700 others, and every city was starting their own little one, and they were throwing $1 million or 10 million or 100 million at it, and money was getting burned left and right, only to find out actually it still even might not today be a profitable business. But that's another story. But the issue was, because it had the local network effects, it had to be valuable where you were based, and that's challenging. It doesn't have the global. You guys have the global for travelers, but you don't have necessarily the global for providers of the services.
Yeah, honestly, great question. I didn't get to talk about it, but Mount's really big defensibility is the way our software works. We built API first, and it allows us to integrate into existing tech stacks of a property. So typically they'll have a property management software. On top of that, they'll have their booking channel, which is Airbnb and others. We integrate into the property management software, who have already curated and found all these hosts globally. So maybe they have 50,000, they have 100,000. That's what makes us so defensible, because when we integrate into those property management software, we're the only solution that hosts can work with within the amenity category. So someone could come up on a local level, but it's not going to work with the PMS, that property management software, and Mount will. So that's why we can beat the local smaller players if they pop up.
Awesome. And what's been the hardest part to date?
Honestly, I was doing this in college and graduated last year. So I'd say that was the hardest, is just figuring out an actual product that people wanted, a solution, I guess you could say. And then finding that product market fit. Getting people believed and bought in, I guess, was not the hard part.
Mm-hmm. It's because everyone's traveled, and it would just be great to have stuff. And a lot of times the hosts have either no stuff or shitty stuff. Yeah.
And it's pretty intuitive. People understand it. So
it is pretty intuitive. And in theory, as you grow and scale, once you've got all the suppliers, you don't just have to be for Airbnbs and for travel. You can be for anyone, for anything, and actually crack the rental market for other products as well, as because it makes no sense for every single person in the US to own their own lawnmower. I'm sorry.
It does not.
It drives me nuts.
Yeah.
Very cool. Very cool. Any last questions on your side, Pratibha?
No, just pretty intuitive and pretty helpful to hear your passion, Madison. Very impressed.
Thank you.
I am very impressed as well by you and by all of our guests. But now it's time to get rid of you and jump into our startup of the night moment. This is where normally there's more of us. Now our votes are very powerful, Pratibha, but we have to kind of,
I was just about to say,
pick one or two favorites and see if we can find a consensus. And the winner, we have our award from the Yugen agency, focused on all things climate. They'll get 5,000 in British pounds for design services. That could be a pitch deck, a website, a landing page, anything to make them look incredibly awesome and professional. And the rest of the presenters, there's a consolation prize for you guys as well. 4WARD.VC/design. So you want to go first, Pratibha, or should I?
Why don't you go first to give me the template, but happy to follow your suit and give everyone feedback.
I mean, I would say for me, all the companies were pretty darn exciting. To be honest, I would say this is one of the better lineups we've had in terms of the potential and the impact of the companies. I would say the two that kind of do it the most for me, Alex and ChillTech, I was very impressed with because of the circular solution to a problem that people don't think enough about, but really is ballooning with I mean, it gets even worse because the world's going to be heating up. So we're going to need more cold storage. So it just kind of self-perpetuates itself. So that is one where I'm very, very impressed by what they're doing and the technology and the team. And the other one that I would say where I see the biggest kind of upside or potential would be phelas with the liquid air energy storage. I'm very excited about what they're doing. I don't know exactly how that plays in with Exeon because I feel like Exeon's solution may be better, but I know that I'm not deep enough into the battery market to fully understand the energy storage side of that. But solving energy storage is one of the major hurdles, both for kind of rolling out renewables, but also decarbonizing renewables, because there's a lot of carbon footprint that's going into renewables that's kind of secretly hidden in there. What do you think, Pratibha?
Yeah, no, thank you for that, Matt, and for giving me the playbook. What I'm actually excited about, firstly, as you said, I agree. This is a fantastic lineup and of different diversified pain points and approaches to solving those pain points. I loved how there is a focus from Factoree on how they're thinking about green production and really seeing, reporting, recommendations and areas that CEOs can better inform themselves. I love how we are thinking about the next gen solar cells. And this is the one where I didn't fully understand, given I was not part of the pitch, but really liked the broader aspect of like the market and how they're looking at replacing silicon as a possible alternative with a possible alternative. I agree with you on phelas, energy storage as a service, on really looking at how they're attempting to solve for that market. For me, the two, quite frankly, are my favorite is Chill Technologies, Matt, what you spoke of, and where I come from, from India, I see a huge need for refrigerated technologies and the way these food waste is becoming a critical portion of the environmental issues and impact that we need to be solving for. And Mount, I think the reuse economy is big. I loved how crystal clear the pitch is and how Madison has been able to prove out the pain points and also look at the traction that she's achieved. So I would say these are the two that I feel are my favorite.
Yeah, I would say Mount for me would be just barely in third place. But I think that puts us at ChillTech being the number one. They're our cool startup of the night, so to speak, which is great news for you, Alex. That means 5,000 pounds from the Yugen agency for design services. I'm not sure what you need, but these guys are awesome and they can help you with that. 4WARD.VC/design for more details and to work with, let's just say the coolest designers in the industry. If you need MVP product mock-ups, etc., they can help you out. 4WARD.VC/design. And I want to thank everybody for tuning into this, for presenting, for sharing. Congrats to Alex for being crowned Startup of the Night. Congrats to everybody for pitching and presenting. Like we said, this was probably one of the heaviest hitting lineups we've had so far on the Startup Tank. Speaking of heavy hitting and lineups, if you want to get into one of our future lineups, it's just thestartuptank.com. You can find us there and apply. And we do this every 2 weeks. We'll have a little break over Christmas, and then we're back at it. If you want to find out more about us and what we do, I run 4WARD.VC. We're an early stage climate syndicate and accelerator that try to be the most hands-on and helpful investors at the table, help you get customers, clients, grow, scale, and inject networking steroids, so to speak, into your company so that you can change the world faster. Pratibha, what about you? Where's the best place for people to find you in Unreasonable?
You can catch me on LinkedIn, so feel free to connect up on LinkedIn. And I'm also available on Twitter at Impact Chats, which is my handle.
Impact Chats. That's a nice one. And guys, all of this is brought to you guys by Carta and Valbon. We love Carta for our SPVs. If you're setting up a fund, if you're setting up an SPV, if you're a founder that's trying to put together a friends and family round or an ESOP or do cap table management, Carta's got the solution for you. 4WARD.VC/Carta for more details. And if you haven't hit the subscribe button yet on YouTube or whatever podcast platform of your choice, shame on you. do that now. Share this with a friend. Help us get these companies in front of more folks, because the exposure, that's what really matters for them, helps them with raising money, growing, scaling, etc. And speaking of raising, if you're looking to raise, we published our Climate Investor VC and CVC database. There's 850 on there. If you're looking to find the ideal investor, you can filter by stage, sector, geography, check size, and find exactly the right person for you. 4WARD.VC/VC database. 4WARD.VC VC database. You can find it all on there. And we've got Slack communities for founders and for investors. It's all on the website as well. Thanks everybody for tuning in. I'm your host, Matt Ward. And until next time, this has been the Startup Tank. Cheers.